Hello everybody, welcome and good morning. I'm Hugh Selby-Smith and beside me is Chad Padowitz, the founder of Talaria. Firstly, I'd like to extend our thanks for taking the time to join this live webinar. Our purpose at Talaria is to help people and communities enjoy a greater certainty around their financial future. Our process benefits from volatility, so we look ahead with confidence on being able to deliver to that purpose in the same way that we have over the last 15 years. Today, Chad and I will talk you through how our process, in combination with the high level of uncertainty currently being priced by markets, allows us to deploy cash into the market at exceptional rates of return that will flow through and benefit the portfolio in the months and quarters ahead. Before we get into the detail, the disclaimer regarding the information we'll be discussing today, and a reminder that this webinar is for wholesale investors only and is not financial advice. Chad and I intend to speak for no longer than 10 minutes. The intention then is to open up for Q&A. I believe that there is the option to submit a question that you should be able to see on your screen now. If you'd like that question to remain anonymous, then please just enter a generic username. Chad.
Good morning, everyone. The last time the markets exhibited such a significant decline alongside elevated volatility was during the GFC. During periods of such high levels of uncertainty, people are prepared to pay an exceptionally high premium to get some level of certainty. What you're seeing on the chart in front of you is a light blue line, which is the VIX, which is a proxy for uncertainty, and the dark blue line is the market movements. And as you can see, the payment remained very high once the market volatility began. So since October 08 to April 09, it stayed above 40, and it was during this period that we were able to generate a significant amount of premium for both 2008 and 2009. Of note is when the VIX when the VIX did go through 40, the S&P had dropped around 30% at that time. But an investor who only had the opportunity to invest in the market would have actually suffered another 34% decline until such time as the market did bottom. Our process, which allows us to get paid a very high rate of return when when VIX is elevated, we can earn that without having to take a view of the market direction or knowing when the market may bottom, such that $100 invested with us in October 08 became 114 to April 09 when the VIX did go below 40, whereas an investment into the market at that time would have gone to $84. What you can see now, if we look at the current situation, which is the yellow line, the level of uncertainty is broadly commensurate with that in 2008. Once again, the payment that we are getting for agreeing to buy shares that we want to own is exceptionally high. This uncertainty we expect to remain high for an extended period of time, given the unprecedented nature of the current pandemic-induced economic disruption. When markets bottom, given the amount of lockdowns that are around the world in different countries, is actually very unknowable. But our process does allow us to generate a very high return on new capital put into the market today, and counterintuitively, it's actually at lower risk.
Not only are we paid increased amounts for committing to buy new shares, but the opportunity set around those equities has increased significantly with the market drawdown. What you're looking at here is a chart showing, really just for illustrative purposes, the number of stocks with a PE below 10 in the S&P. You can see that before volatility picked up in the middle of February, that was around 10% of the S&P 500 traded with a PE of 10 or lower. Through our process, many of those stocks, even though they're lowly rated, did not reflect cheap equities. They had impaired balance sheets, poor liquidity. A number of them had issues around off-balance sheet liabilities, and indeed their future prospects look fairly dim given the changing nature of the economy that we see around us today. Contrast that to 1 month later, around about a third of the S&P is trading with a PE below 10. Many of these companies are conservatively managed, have strong liquidity positions, serve markets that will be necessary going forward in the future, and have extremely strong balance sheets. So from a bottom-up perspective, not only has the payment that we're getting for committing to buy shares we want to own increased, but actually the opportunity set of companies has increased dramatically. Given that, we've been deploying around about 6.5% of the fund's cash into the market over the last 8 sessions. To show how our process benefits from higher volatility, I now want to walk you through one of the securities we've deployed cash into as of last Thursday. That company is Roche, the Swiss pharmaceutical company which has the world's leading oncology franchise and until recently had the largest cash R&D budget in the world. We committed to buy Roche last Thursday, and by way of contrast, I've shown everything 1 month prior, just before volatility started to increase significantly, to show you how we benefit from the current regime. As of last Thursday, over the preceding month, you can see that Roche had declined 17%, and so was trading at 290 Swiss francs per share compared to 351 just a month earlier. We were able to commit to buy Roche at 240 Swiss francs a share. The commensurate level only a month earlier would have been 340 Swiss francs per share. And yet, perversely, the payment for committing a stock to buy Roche 35% lower more than doubled to 15.5 Swiss francs per share. So that's really the payment that Chad was referring to, that the market is prepared to give us to alleviate their extreme level of uncertainty. From a contracted rate of return, that works out at over 25% per annum. That is a contracted rate of return that we received last Thursday, committing to buy Roche at 240 Swiss francs. The stock needs to fall another 66 Swiss francs until we start to lose money on the trade, and that really is a good reference to Chad's point that we don't have to take a view on the market to be paid an exceptional rate of return. So the total buffer to loss is about 23% on top of the 17% decline in Roche that we've seen in the last month. You can see that the dividend yield were we take to receive the stock at 240, and remember we only do this on equities we fundamentally want to own, was 4.1, would be 4.1 compared to 2.6 only a month ago. And here's the valuation that I referred to earlier. At 240 Swiss francs a share for the world's leading oncology franchise in pharmaceuticals, a fairly non-discretionary area of spend, given it's life critical, we'd be paying about 10.9 times PE compared to a month earlier we'd be committing at 16.9 times PE.
I think it's worth highlighting that Roche's quality and strength of balance sheet and stability of cash flows is actually lower risk according to the bond market than US government debt. Such is the strength of that franchise. But however, with increased volatility, we are still able to get a greater than 25% return, which is double that was available just a month ago. The buffer against the loss has quadrupled, and if we do end up owning the equities, which we hope we do, we will have a 50% upside at that price versus fair value just a month ago. And as importantly, the yield that we would get on that is well over 4 times that on a commensurate US government debt. So just to summarize the Talaria opportunity, our process benefits from volatility. From the income we generate to the quality of company we can buy. We haven't changed what we've done in the last 15 years. Merely the benefits of how we do it are now quite extreme, favorably, obviously. And, you know, as we earn through the income generation process, and as we deliver that for our clients, we are able to provide both existing and new clients a far greater level of certainty in what is now a very uncertain environment. Thank you for your time on that. We will now move to Q&A.
Great, thanks, Chad. Questions? Okay, a number of you have asked in general terms about wanting to understand the consistency of income generated and the distributions from Talaria. What can people expect next quarter? How should they expect when volatility reduces, what that will mean for distributions? Perhaps you'd like to answer that, Chad?
Yeah, sure. So quite importantly, our income is differentiated from many others, such as dividends, which, just out of context, about 50 companies in the S&P have cut dividends in the last week. US banks can't return capital anymore. So, you know, certain forms of income are more powerful than others. Ours is differentiated through option premium, which actually goes up in environments like this. Certainly over the last 10 years, we have never generated less than 8% of income when you take income and, you know, some level of dividends into that. You should expect that number to be higher going forward. As you know, as I'm looking at the portfolio every day, I can give you great comfort that the income is coming in at a significant rate, and you should expect the distributions that you've been expecting in prior years to be there, and if not higher, in the quarters and years to come.
And when do you expect volatility to reduce?
Well, as I showed on some of the prior graphs, volatility stays elevated for an extended period of time. It was stayed elevated for 7 months above 40 in the GFC, and then it stayed at a pretty high level for even extending that time. So we don't see this opportunity set declining anytime soon.
Okay. There's been a number of questions about will the Talaria performance lag when we move into a recovery phase in the equity market? Yeah,
well, given the current environment where we're able to buy very high quality companies at very attractive valuations, as well as get an exceptionally high level of income, that will persist for quite some time. And the best reference I can give would be because in 2008 and 9, because we were generating so much income, around 18% in 2008 and around 14% in 2009, plus buying these companies at attractive valuations, we were able to, in US dollar terms, do approximately 40% in the calendar year 09 versus the market doing around 30. So that should give you some idea that we are very well placed for when things do actually recover.
Yeah, and I think it's worth adding that from that October 08 level that you referenced, the $100 to $114 by April 09, if you take that with 3 years, actually 100 best if you invested in the benchmark years later. Yeah. So there's actually historical precedent that in no way do we lag in a bull market or when we start to recover, because we get more equitized and we own more companies when they're cheaper. And obviously that sets up what we're seeing at the moment, the next leg of returns.
Yeah, indeed.
There's a question here which I think you're probably best placed to answer, Chad. I'll be interested to find out about the liquidity of the options market. Obviously, that's a fairly topical discussion across a whole range of markets. And you talk about the ability to access the market and the costs.
Cool. Thanks. That's actually a very good question. First, I'll just reiterate, for the absence of doubt, every option we sell is exchange traded, so there is no counterparty risk. But importantly, and this is kind of the opportunity set, we are the liquidity providers. question is there liquidity? We are the liquidity provider. We are naming our price because people are looking for certainty and paying up for that. So there is no concerns whatsoever about liquidity and the ability to access these opportunities.
Okay, thanks. What is the time frame for new put options?
So when we commit to buy a share sometime in the future, we get paid the money. So that is contracted. We receive the money, but the actual performance is in a time frame until that option actually expires. So importantly, the generation of income we've produced in the month of March, which is north of 2%, hasn't yet shown up in performance. Basically, the weeks and months progress when options ultimately expire.
How do we know that we're not buying falling pianos, as this person has termed it? Would you like to talk about that?
Sure. Yeah, I think it's a very important question in terms of value traps and so on. Importantly, a lot of the shares we are buying today, or committing to buy today, have dropped 25 to 30%, but we are only committing to buy them another 25 to 30% lower than current price. So we are not, it has to fit. And as we referenced in one of the examples of Roche, these are very high lead quality companies. These are businesses that are the leading, Roche in oncology. We have the leading drug distribution company in the world. We have the leading electrification of low voltage energy. The companies we are buying are very important for the world to come, as long as they have the quality of balance sheet, liquidity and solvency to see through the other side. Then there will be very good investments, and we are very confident that the companies we are buying match those stringent quality and balance sheet criteria. Is there something you might want to add?
Yeah, I think I'd just add that at the heart of our bottom-up stock picking process, we always start with the recognition as equity holders that we're subordinated in the capital structure. So liquidity, balance sheet strength, off-balance sheet liabilities, lease commitments are really where the majority of our first investigation of the company starts. So all of the companies that we own today have a position in the economy of tomorrow, and they have the liquidity and financial strength to be able to endure whatever is going to actually transpire in the economy. So I don't think that's any change. That's just a consistent part of our process, but it is something that is obviously fairly crucial. So these companies are important, and as Chad said, a number of them are world leaders in their field. Can you talk about the ratio of, there's a question here about the ratio of options that are being assigned. Perhaps I'll take that one. Really it comes down to the buffer that Chad was referring to. So every new dollar, obviously, that's put into the market today, really the likelihood of gaining access to that stock or otherwise is just actually a mathematical distribution. That's what volatility is. We've had, over the 15-year life of the fund, a very consistent exercise ratio of about 1 in 3, and that is no different to the new capital that we're deploying today. Clearly, stocks that we committed to buy 2 months ago, 3 months ago, through our process we thought were cheap on a through-cycle valuation, they are slowly moving into the portfolio as the market gets cheaper. And of course, that is how we balance up and get equitized as the market gets cheaper. So our process overcomes the fear of missing out on one side, but also the fear not to act when there's excellent opportunities in the market. There's another question here. Can we provide, Chad, another example of stocks you've had the opportunity to buy in that 6.5%? Is there anything particularly that you'd highlight there? So as an example, we've recently committed to buy a company called Swiss Re. Swiss Re is one of the largest reinsurers in the world. They've, we like to say they're in the business of staying in business. That company has a book value of about 100 Swiss francs a share and around
a 6 Swiss franc a share dividend, which is exceptionally strong, and they've just recommitted to that dividend just last week. Those shares are trading at around 60 Swiss francs now. So 60 cents in the dollar, 10% Swiss government yield, with a credit rating that only a north of 100-year-old Swiss reinsurer is acceptable. So that's an example. I can give more if you think.
Well, Medtronic's a good example as well. I think it's a stock we've owned in the past. We actually sold because of the valuation.
Yeah. So Medtronics is a med tech company, medical equipment. They, like Roche, actually have a CDS or a guarantee. Their cost of guaranteeing their debt's exceptionally low. That is also a company that's dropped around 30%. We're able to buy that 25% lower than the current price at around a 25% return. That is just not commensurate with the kind of balance sheet, the kind of risk, or the kind of company that is. So we've been adding to that. Yeah.
Okay, here's a one that obviously we've talked a lot around on the desk. You used to own oil stocks as a firm. I guess that was late 2015. Yeah. Any view on the sector now?
Right. So we used to own them. We did sell them, fortunately, because our view that shale was just such an indestructible source of supply that would keep oil prices low for an extended period of time. So now, obviously, the current oil price is significantly depressed for obvious reasons. Both there's a demand shock as well as a Saudi-Russian supply price war going on. We do have some small exposure to what we think is a very well-capitalized and cash-generative business. Even now, we only have about a 1.5% exposure to the fund at the moment to that. That company is currently paying a dividend yield, Canadian Natural, of 16% dividend, which they recommitted to their dividend about 4 or 5 days ago. But yeah, we're not. I'm not going to say we're particularly favourable of the oil price or sector at this time, but like all sectors and companies, and we're looking at opportunities every day.
I would highlight that we actually, in part of that 6.5%, committed a little bit of extra capital to Canadian Natural on the basis of what you talked about. So we are slowly actually getting a little bit of increased exposure compared to the last 3 years. But it is certainly an area that all of us in the analytical team have been spending time on. Yep. I think there's some long-term structural issues, albeit the value of the assets in the ground are clearly discounting sub-cost of capital returns in perpetuity from today's level. Can you talk a little bit more about the fact we're getting greater market exposure as stocks become cheaper? How does that kind of work in practice?
Yes. Okay. If I understand the question directly, so obviously when we commit to buy a share at a certain price, as the market goes down and those shares go down, we do get that. Every share we own in the fund begins life as an option, so there's no other way to get it. But the process is designed that when the opportunity set is low, we tend not to get those shares because the market's expensive and going up. When the opportunity set increases, we then do want those equities because the upside is then quite significant. And that is happening at a gradual pace today. Not much different to how it happened in the GFC, which is just a slow incremental increase in equity market exposure, which is only a good thing given the opportunity set we see ahead of us.
Yeah, just to put that into context, perhaps with some numbers, at the Q4 of 2007, I think the fund had its lowest market exposure, just below 60%. That was pretty similar in parts of last year, actually, given our view on the opportunity set from a bottom-up perspective. The highest market exposure in the 15-year fund history was at the end of Q1 2009, and that really demonstrates that as the market gets cheaper, we get greater exposure to be able to set up that participation as asset prices recover. So that was a strong proof point over that period, and it's happening at the
it's happening now, and it will continue to happen.
And of course, we're happy for it to happen. There's on equities that we think actually offer a fantastic long-term opportunity. Now, we've probably got time for one more question. I've been given the wind-up here. Any comment on the impact of recent FX moves?
Right.
Anything you'd like to add there?
Yeah, now, As many would be aware, the volatility in FX markets, the volatility in the world has not escaped FX markets. So it's not just the Australian dollars, but currencies all over the place are moving quite substantially, predominantly to a strong US dollar because of some level of liquidity crunch going on. Substantially all our investments and money is obviously outside of Australia, so we are a beneficiary from a weaker Australian dollar. Bear in mind, our assets are not just US dollars, they're in pounds, yen, Swiss francs, euros, and those have been moving quite a lot themselves. So we are a net beneficiary when the Australian dollar does decline and have benefited somewhat from that.
Okay, well, I think we've pretty much run out of time there. For colleagues that were not able to join live today, I think we'll be able to make a recording of this webinar available. I've been given a thumbs up on that. For those people who asked a question and that was not answered, we will endeavour to respond in person directly. Or should you have a follow-up question, of course, on reflection too, please reach out to us. Thanks very much for your time today. Hope it was useful. Get in touch if you'd like to know more, and best for the rest of your day.